Welcome, you're watching NDTV Profit. I'm Tamanna Inamdar and you're watching Earnings Edge. The company we're focusing on today is a recently listed parent of Mamaearth, Honasa Consumers. Their Q3 numbers are looking great on the face of it. The net profit has soared 265% year on year. Margins have expanded by close to 400 basis points. Now, the question is that can they see sustained revenue growth? From the con call, the management has indicated that consumption has been slow. When do they see a recovery on this? This and a whole host of questions now for the Chief Financial Officer, Ramanpreet Sohi, who's joining us on the show. Ramanpreet, hi. Great to speak with you here on NDTV Profit. Let's begin by talking about this quarter and what has driven those profit numbers. Your margins also have expanded, very decent expansion there. Net profits have also expanded. Are you seeing this coming in from revenue growth or from a curb on operational expenses?
Yeah, no, absolutely. Hi, good morning to you. Thanks for having me. Like we said, of course, we delivered almost 28% growth for the quarter. And from a like-for-like basis, which is our product business, actually delivered 30% growth. So as we sort of see scale up for our brands, Mamaearth and our younger brands, we're clearly seeing the scale up happening at an efficient, leverage across A&P and some of the other line items in our P&L. Of course, a larger sort of driver for our margin expansion has been efficiency in A&P, which has been optimized by almost 200 bips from a year-on-year basis. I think that continues to be our biggest lever in terms of margin unlocking as we look ahead. And I think in our views, we think we have clear levers to unlock about 100 to 150 bips in operating margins from a year-on-year perspective. And of course, the growth has also, at a 30% kind of a growth from a YTD perspective and for the quarter perspective, that of course also helps leverage to kick in across A&P and other line items, which has helped our operating margins improvement almost 400 bips.
Okay, so you're saying that you could see another 200 bips improvement in operating margins because of efficiencies. Can you go into a little more detail on that, Mr. Sohi? How exactly are you achieving these margin efficiencies?
Yeah, so, I said about 100 to 150 bips from a year-on-year perspective. What we've seen is as we sort of move our largest brand, Mamaearth, into offline, that channel is clearly more profitable, and we're clearly seeing that play out in our margin profile. Also, our younger brands, the Derma Company, Aqualogica, Dr. Shade, B Blunt, all of these brands, as they scale, we're clearly seeing efficiency, of course, led by A&P reinvestments. And our second largest brand, Derma Company, actually turned profitable for the year. So this is the first full year of profitability for the brand. And clearly, at a certain scale and threshold, we see brands turn profitable. The other younger brands are currently in an investment phase. But as they have continued to scale, we've continued to see at each level of scale up efficiency coming in. All of that is playing out at an overall EBITDA margin profile as well for us. So clearly, as we sort of focus on deepening and going to further penetrating on the offline distribution side, and as we further continue to scale our younger brands, we should be able to unlock these margins. I think we have clear levers to do that as we look ahead into.
Okay, couple of follow-ups there. You're saying the offline mix improvement for Mamaearth helps better margins in offline. What is the ratio right now? And how many of your brands are now profitable out of the whole pack? I think 6 in all. So apart from Mamaearth, which are the other ones that are profitable?
Yeah, so from a sort of channel perspective, offline in Mamaearth contributes close to 50% of the business. 45 to 50% of the business comes from offline. And of course, this was less than 10% about 2.5 to 3 years back. So there is a clear ramp up on the offline distribution side. We today reach 1.7 lakh retail outlets. The distribution is up 36% from a year-on-year perspective. We continue to further strengthen and stabilize and then sort of focus on further expanding our offline distribution from here on. In terms of, from a profitability perspective, of course, Mamaearth being the largest brand is the most profitable brand. Derma Company, like I said, our second largest brand, has become profitable. Other brands are clearly seeing improving margin profile, but currently are in an investment sort of phase.
Last quarter, Mamaearth's offline component was about 60%. I had a conversation with your team and it was 60%. So has that dropped? And what is the outlook for the offline margin or the offline business component for the primary brand, which is Mamaearth?
Yeah, no, so I think we've never gotten to 60%. I think from a offline contribution, we've been at this range of 40 to 50%, and of course from 40% odd last year, it is now moved down to 45 to 50%. So there is a ramp up as we sort of continue to increase our distribution. So I think offline from a Mamaearth perspective, very clearly we see at least 2 to 3 times distribution expansion possibility over the next 3 to 4 years for Mamaearth. In terms, we currently, like I said, are present in about 1.7 lakh retail outlets. There is a clear headroom there, and of course, from an overall perspective, online offline will probably balance because the younger brands are focused on digital first online platforms and our own D2C website and e-com platform. So I think given their scale up and journey, we'll probably see a balance in online offline at about 50-50, maybe from a 2 to 3 year perspective.
All right. And what is the dependence on Mamaearth in contribution to your revenues? If you can just give us a sense there. How much is coming just from the mother brand?
About 68% of the business is Mamaearth.
Did I hear 68%?
Yeah.
Okay. And do you see that reducing over time as you load on other brands? Will you be adding more brands in this year?
So, of course, the younger brands' growth profile is faster. So from that perspective, the mix will change a bit in terms of the younger brands over time, because the younger brands are at a level where the growth profile of those brands is faster. So we'll see that play out. Sorry, I didn't catch your second question. Can you
How many more brands are you adding? I think 23 was quite a big year in terms of acquisitions, adding on more brands. Are you going to continue at that pace? Are you adding more brands in this financial year, or are you now going to just consolidate what you have on board?
So I think we obviously clearly see certain white spaces. We've been focused on building our brands and scaling our current portfolio. There are certain white spaces where we continue to focus and work on those white spaces. Of course, as and when we launch a new brand, we'll obviously disclose that in the right time. But of course, we are interested and we're looking at certain white spaces. We will see some action from our side on that front.
I know you're not going to tell me what you're buying, but what are these white spaces? Which categories?
So we're not buying anything. When I say white spaces, most of our brands are organically built and scaled. We've done 2, of course, brand acquisitions, but our largest brands are organic brands. So there is nothing on the table from an organic perspective. When I mentioned white spaces, it is from an organic perspective.
And which are these white spaces? Which categories, at least?
Yeah, so I think one clear category, which has given us a lot of confidence is the color cosmetics. It's a large space. Within Mamaearth also, we've been able to build this category. Now it's almost 150 crore annual run rate category for us. So I think with that, we clearly see that, it's an interesting category. We could look at launching a separate brand for the larger performance-led color cosmetics space. So yeah, so that's how we sort of see a clear sort of white space. I think that's probably one big white space currently. I think there are others, but we'll probably talk about it at the right time.
That's nice. So color cosmetics. So more of color cosmetics in terms of expansion. Or another thing I want to talk to you about is the seasonality that we've seen. And in the con call, etc., the commentary has been that there is a bit of a consumer slowdown, not just in rural, but in urban areas as well. Has the festive season not lived up to what you expected? Are you seeing a pattern here in terms of which categories are seeing less demand?
Yeah, so I think, like you said, of course, we are seeing a little bit of pressure in terms of how demand is panning out. Especially, I think what was sort of clearly visible in rural is now starting to impact the urban markets. Like you said, of course, the festive didn't pan out well for the e-commerce platforms. The certain, what we are also reading is the offtake from a GT, general trade outlets specifically, also has been slow, and of course that has meant that a lot of the companies, the larger incumbents who have not been able to see volume growths, are also sort of going aggressive and giving steeper discounts across e-commerce platforms. So all of that is also adding to the competitive intensity. So yes, I think we see, I think at least in the near term and to a certain extent medium term, some level of pressure coming on the consumer demand side.
By when do you see that easing, or what do you think will ease that?
I think it's very difficult to pinpoint exactly when will that sort of turn around. But at least in the near term, next couple of quarters, we see that play out. I think we'll probably take it from there.
All right. Thank you so much, Ramanpreet Sohi, for coming in today, answering all of our questions. And on the face of it, the numbers actually look very good. There's another income component, but I have not had a chance to ask Mr. Sohi about it. Very quickly, Mr. Sohi, your other income has increased to about 100 crores. Can you give us an idea what that is?
So it's about 10 crores for the quarter. I think that's because
crores.
we've done, we've raised primary through IPO. So we park those funds, in certain fixed deposits, which is yielding certain interest income. So I think that's it. There are clear plans to invest that as we are aligned in the IPO.
All right, that's a smart move as CFO, as interest rates go up. Thank you so much, Mr. Sohi, for speaking with us.
Welcome. This is Earnings Edge, and we are taking stock of earnings from Electronic Marts India Limited, where it's been not only a strong quarter, but also a strong 9 months coming through on account of the expansion that the company has taken through the course of the last few years. And well, that perhaps is also playing out in terms of the kind of growth that we are seeing as far as the company is concerned. But to take us through the numbers, as well as what we can expect going forward, we are in conversation with the CFO of the company, Premchand Devarakonda. Prem, good morning. Thanks so much for joining in. Let me start by asking you about how your assessment of the quarter has been and what are the key highlights here?
Yeah, I would say that this is a wonderful quarter. So maybe the best in the history. What happened in this quarter, two significant things happened. One is the entire festive season fell in this quarter, and second is the World Cup. So because of that, there is definitely good growth in all the categories. So it is positive on our side.
Right. Prem, I want to understand your geographical current standing as well as expansion going on. Now, from what I gather is that at least your physical presence is in Andhra Pradesh, Telangana and Kerala. Can you tell us about the plans on the anvil with respect to how many more stores that you are looking to perhaps add, not only in the fourth quarter, but maybe the plans that you have for FY25? Secondly, what geographies will these physical brick and mortar stores come through? And thirdly, if you could also give us an idea about your online presence and where that can expand, whether or not that can expand to other states. Again, for the benefit of our viewers, you are present as far as your online is concerned in Maharashtra and Delhi NCR. Can you take us through all these factors?
First thing, I would like to correct a small thing. Our presence is AP, Telangana and NCR. So in Kerala, we had just only one store. It's only an experimental stage. So our focus will be on existing markets like Andhra Pradesh, Telangana, and NCR. So as we speak, we have close to 15 stores operational in NCR, and the balance about 135 stores are operational in AP and Telangana. So, and then in Kerala, we have only one store, so that can be neglected. And then second part is our future expansion. So we will be organically expanding our stores in the AP and Telangana states. Maybe by end of this financial year, we will be adding at least 3 to 4 more stores in existing markets. and close to 5 stores will be added in NCR. So that will be our plan for the current financial year. And next year, we'll be adding 25 more stores in these 3 markets. So these are all large format stores. And coming to that online presence, like our focus is only limited in this online platforms. We are selling through Flipkart and Amazon platforms, and that contributes less than it's about 1% of our top line. So that's why our total entire focus will be on bricks and mortar stores.
Right. Well, if you can then in that case also give us an idea about the split in terms of mobile phones, electronics, and of course large and small appliances. How is this ratio currently standing, and whether or not you do in fact expect a little bit of a change, a little bit of a shift as we move into the next year?
Historically, this ratio remained more or less same. I mean, I'm talking about in the over the last 3-4 years. So since the this what you call smartphone revolution, so mobiles have been contributing the maximum. So that is almost 1/3 of our sales come from mobile segment only, and then air conditioner is around 12%. Laptops is about 5%, refrigerators will be 10%, and home entertainment will be another 16%, and others will be 15%. And this mix will more or less remain the same, even if we compare the previous quarter to the current quarter. So the sales mix is more or less same.